The
We
dollar doesn't
understand the
collapse in a
challenges
single
you
moment.
face,
It
and we are
erodes
here to
quietly
provide
and
the
fails
solutions you
suddenly.
need to
And the clearest
succeed
signal of that
in this
failure is
evolving
emerging
market.
into one
We
market the
understand
financial
the
system
challenges you
cannot afford
face,
to lose:
and we are here to
silver.
provide the solutions you need
Prices
to
shattered every
succeed
record in
in
early
this
December
evolving market.
2025, pushing past $59 per ounce as futures markets showed signs of stress. JP Morgan moved roughly 169 million ounces into its vaults, nearly 9% of global supply, during the same window. Major Asian banks halted retail silver sales. China restricted citizen purchases. Spot prices traded above futures for the first time in decades, a condition normally reserved for markets in distress, not stability. This isn't speculation. It's what markets do when faith in currency weakens. They migrate toward assets that cannot default, cannot be printed, and cannot be devalued by decree. Behind the numbers, a more serious pattern is forming. COMEX inventories continue draining at the fastest pace since 1980. More than 37 million ounces vanished from registered stock in just 47 days, leaving the market with levels that cover only weeks of global consumption. When an exchange built on leverage begins losing the physical metal underlying its contracts, confidence doesn't fade gradually, it snaps. This shift isn't driven by investors chasing momentum. It's driven by institutions preparing for a world where the dollar no longer anchors global value. Russia now classifies silver as a strategic reserve asset for the first time in 170 years. China's industrial expansion consumes more silver than its mines produce, forcing persistent imports and quiet accumulation. Nations move early when a currency regime nears its exhaustion point. The implication is hard to ignore. If the dollar enters a structural decline, the system must find a replacement store of value. Gold absorbs part of that role. But silver, both monetary metal and industrial lifeline, becomes the bridge between collapsing confidence and tangible wealth. Not because markets choose it, but because manufacturing, energy systems, and the financial architecture itself depend on it. This is the environment entering 2025. A weakening currency, a tightening metal, an overstretched paper market facing physical scarcity, and a global system preparing for the return of real money. The financial system enters 2025 under strains that no longer look temporary. The dollar weakens as rate cut expectations climb above 87% according to market-implied probabilities. A softer currency normally supports precious metals, but this time the reaction in silver is disproportionate. Prices aren't rising on momentum, they're rising on shortage. Silver's surge past $58 and towards $60 reflects more than speculative demand. It reflects tightening conditions in the physical market. Exchanges report persistent inventory declines across major vaults. COMEX registered stocks fell by more than 37 million ounces in 47 days, the fastest depletion since 1980, when the market last approached systemic stress. Registered supply now represents only a fraction of global monthly consumption. That type of drawdown does not reverse without a structural catalyst. Market anomalies confirm the imbalance. Spot prices trade above futures, signaling backwardation. This condition appears when buyers prefer immediate metal over future delivery. It is the clearest sign of physical scarcity and a breakdown of normal cost of carry relationships. Backwardation is not a sentiment signal. It is a liquidity warning. A system built on promises is being forced to settle in metal. Banks are reacting. South Korea's largest lenders halted silver sales entirely. China restricted citizen access to precious metals. These decisions were not framed as market interventions. They were framed as risk management responses to tightening supply conditions. When major financial institutions withdraw from a market, they do so because availability no longer meets demand at stable prices. It is the same behavior seen in oil during the 1970s, palladium in the 2000s, and wheat during historical shortages. Withdrawal precedes repricing. Institutional positioning reinforces the trend. JP Morgan expanded its physical holdings to an estimated 169 million ounces in COMEX vaults alone, nearly 40% of inventory under the exchange's control. Their long accumulation since 2011 signals long-term strategic intent rather than trading activity. In markets dominated by leverage, The largest actors accumulate real assets only when they anticipate the credibility of paper claims weakening. Nations are reaching similar conclusions. Russia formally reintroduced silver into its strategic reserves for the first time in over 170 years. China, already the largest consumer in solar manufacturing and electronics,
We
imports more
understand the
silver than it
challenges you
produces.
face, and we
These
are
flows
here
are
to
not
provide the
investment flows,
solutions you
they are
need
supply
to
security
succeed
flows.
in this evolving
Countries
market.
secure inputs
We
essential for
understand the
energy
challenges you
systems,
face,
industrial
and
production,
we are
and
here
monetary
to provide the
stability.
solutions you
The
need
dollar's
to
decline
succeed
accelerates this
in this
shift by
evolving
undermining
market.
trust in financial reserves held abroad. The result is a market losing the buffers that once absorbed volatility. Inventories are thin, paper leverage is extreme, industrial demand is inflexible, policy uncertainty is rising. A weakening dollar amplifies all four simultaneously. This is why silver is no longer trading like a commodity. It is trading like collateral, scarce, essential, and increasingly sought in physical form. Demand for silver is no longer cyclical. It is structural, policy-driven, and embedded in the mechanics of modern industry. That shift changes how the market behaves. Prices no longer reflect investor sentiment. They reflect technological necessity. Industrial consumption reached levels unmatched in history. Roughly 59% of global silver demand now comes from manufacturing, up from about 40% a decade ago. This acceleration results from a single trend: the electrification of everything. Homes, vehicles, grids, and data systems are moving toward higher conductivity requirements, and only silver delivers the needed performance. No other metal combines electrical, thermal, and chemical properties at the same efficiency. Solar manufacturing is the clearest example. Photovoltaic demand consumed nearly 200 million ounces in 2024, almost triple the level recorded in 2020. Global energy policies ensure that growth continues. The International Energy Agency expects solar deployment to expand through the decade as nations target decarbonization. Every panel requires silver paste. Efficiency losses from substituting copper or aluminum remain too large to justify redesign. Industrial users can reduce silver usage per cell only marginally. Total consumption still rises because the installed base expands faster than material savings. Electric vehicles amplify the trend. Each EV uses roughly twice the silver of a traditional combustion vehicle due to increased circuitry, sensors, and power electronics. EV adoption is accelerating across China, Europe, and the United States. Subsidies, emissions rules, and consumer incentives make this shift irreversible in the near term. Even modest annual growth adds persistent pressure to a resource already in deficit. Digital infrastructure adds another layer. 5G towers, AI data centers, medical devices, and precision electronics all rely on silver for conductivity and signal integrity. These applications are not discretionary. They form the backbone of national competitiveness. During shortages, governments protect industrial access at any price. That dynamic transforms silver into a strategic input rather than a commodity. Nations recognize the shift. Russia's decision to classify silver as a strategic reserve asset marks the first official monetary use of the metal by a major state in more than 170 years. China's behavior points in the same direction. It produces roughly 3,300 metric tons annually, but consumes far more. Its dominance in solar panel manufacturing, EV production, and 5G infrastructure forces sustained imports. Accumulation becomes a requirement rather than a choice. When major economies secure metal for industrial continuity, they remove supply from global circulation for decades. These demand drivers operate simultaneously. Renewable energy mandates expand. EV adoption increases. Digital networks proliferate. Medical technologies scale. Each sector requires silver. Each has limited substitution potential. And each is projected to grow faster than global mining capacity. This places silver at a unique intersection. It is a monetary metal in a period of weakening currencies. It is an industrial metal in a period of accelerating technological build-out. When monetary stress converges with industrial necessity, scarcity becomes systemic rather than cyclical. The pressure on silver supply is not the result of temporary disruptions. It is the outcome of geological limits, declining ore grades, in a mining sector unable to expand fast enough to match structural demand. Supply is inelastic by nature, and in commodity markets, inelastic supply paired with accelerating consumption produces only one result: deficit. Global mine production has been trending downward for nearly a decade. Output has fallen roughly 7% since 2016, even as industrial demand surged to record highs. New primary silver mines are rare because most accessible deposits were developed long ago. The remaining ore is deeper, lower grade, and more energy intensive to extract. Mining economics do not improve simply because
We
demand
understand the
rises.
challenges you
They
face,
improve only
and
when
we are here
sustained
to
higher
provide the
prices
solutions you
justify
need
capital
to
investment.
succeed
And
in this
even then,
evolving market.
lead times stretch
We
across 7
understand
to
the
10
challenges you
years.
face, and we are here to
70%
provide the
of global
solutions
silver
you need
output comes
to
as a
succeed
byproduct
in
of
this
copper,
evolving
lead,
market.
or zinc mining. That structure creates a supply trap. If prices for base metals stagnate, new projects fail to move forward, regardless of silver's price. The industry cannot open mines solely to produce silver. As a result, supply cannot scale with the needs of solar manufacturing, EV production, or 5G infrastructure. In other words, the market is constrained not by price, but by geology. Recycling offers little relief. Recovery rates for electronics remain below 20%, making urban mining uneconomic at scale. The largest growth sector, solar, locks silver inside panels for 25 to 30 years. That material will not re-enter the supply stream until the 2040s or later. Even optimistic recycling projections cannot offset multi-year structural deficits. The deficits themselves are now defining the market. The global silver shortage totaled roughly 148.9 million ounces in 2024, marking the fourth consecutive deficit year. Cumulative deficits from 2021 through 2024 reached approximately 678 million ounces, the equivalent of nearly a full year of mine production consumed without replacement. The 2025 outlook shows no meaningful improvement. Industrial demand continues rising. Mining output remains flat. Recycling is stagnant. The gap persists. Inventories bear the weight of that imbalance. COMEX registered silver has collapsed from about 152 million ounces in 2021 to roughly 73 million ounces in late 2024, and the drain continues. The market lost 37.6 million ounces in just 47 days, the steepest decline since the 1980 silver crisis. Registered stock now hovers near levels that represent only weeks of global industrial consumption. When an exchange loses its deliverable inventory, the paper market becomes a risk rather than a benchmark. London vaults follow the same trajectory. Inventories fell toward historic lows, with a significant portion already allocated to ETF holdings, and therefore unavailable to satisfy industrial demand. What remains is insufficient to buffer multi-year deficits. The system survives only as long as no major industrial buyer demands guaranteed long-term supply. The moment that changes, the shortage becomes visible. These constraints converge into a simple equation. Demand grows, supply does not. Inventories decline, recycling fails to fill the gap. Each year of deficit pushes the market closer to a point where shortages become public, not theoretical. And once shortages become public, the behavior of the market changes. Buyers stop managing cost. They start securing survival. The pressure building inside the silver market does not stay contained. Once physical scarcity intersects with financial leverage, the system begins producing nonlinear outcomes. Prices move differently. Institutions behave differently. And paper markets lose the authority they once held. The first break appears in the futures market. COMEX carries open interest representing more than double the silver stored in its vaults, and more than 18 times the metal classified as registered and ready for delivery. That ratio is not a sign of liquidity. It is a sign of fragility. A leveraged structure functions only when few participants request physical settlement. As inventories decline, the margin for error disappears. The market already shows symptoms of strain. Backwardation, spot prices trading above futures, signals a shift from speculative demand to immediate physical demand. It means buyers no longer trust future supply at today's prices. They prefer the certainty of metal now. In commodities, backwardation is a warning. In monetary metals, it is an alarm. Institutional responses reinforce the stress. South Korean banks halted silver sales entirely, not as a trading decision, but as an acknowledgement that sourcing physical metal had become uncertain. China restricted retail access. Russia withdrew from Western exchanges. These actions remove liquidity from the system at the exact moment liquidity is needed most. They also convert a market event into a geopolitical signal. Major economies are prioritizing national resilience over global consistency. Even infrastructure shows signs of pressure. CME halted trading during a period of rapid price acceleration, citing a technical outage, while silver temporarily spiked above $56.72, with bid-ask spreads widening beyond normal thresholds. Markets rarely freeze because of cooling failures. They freeze when liquidity thins, volatility surges, or a dominant participant faces losses large enough to destabilize the system. Such halts indicate the paper market is
We
struggling to
understand the
absorb physical
challenges you
driven
face,
volatility.
and we are here to
The
provide the
reaction extends to
solutions you need
inventories.
to
JP
succeed
Morgan
in
shifted
this
roughly
evolving
13 to
market.
14 million
We
ounces from
understand the
registered to
challenges you
eligible,
face, and we are
effectively
here
removing
to
metal
provide
from
the
deliverable
solutions you
supply during
need
peak
to
demand.
succeed in this evolving
Eligible
market.
metal cannot satisfy futures contracts. It can only sit in storage. That reclassification tightened an already thin market and signaled something more important. When major holders retreat from deliverability, the mechanism underpinning price discovery weakens. As the financial side fractures, industrial users quietly prepare. Manufacturers dependent on silver, solar firms, electronics producers, defense suppliers, cannot tolerate supply interruptions. Their demand is non-negotiable. When inventory risk rises, they begin stockpiling. This behavior mirrors the palladium market of the early 2000s, when Russian exports slowed and automakers hoarded material, pushing prices from $500 to $3,000 per ounce in 4 years. The lesson is clear. When industry moves, shortages accelerate. Monetary dynamics amplify the effect. A weakening dollar increases the appeal of physical assets. Nations with exposure to US debt diversify. Investors seek protection against monetary dilution. Silver's role expands from industrial necessity to monetary refuge. The dual function magnifies upward pressure. Each move creates another. Each reaction tightens the market further. This is how a commodity transforms into collateral, not through speculation, but through structural imbalance, not through narrative, but through math. Once shortages collide with leverage, the system does not rebalance, it rewrites the price. The path ahead is shaped by forces already in motion. None depend on speculation. Each is anchored in structural shifts that began years ago and are now converging. As the dollar weakens and physical silver tightens, the market moves toward an environment defined less by price discovery and more by availability. The Federal Reserve remains the immediate catalyst. Markets assign more than an 87% probability to a rate cut, a decision that typically pressures the dollar and accelerates flows into hard assets. In this environment, silver behaves differently from past cycles. Monetary easing no longer interacts with abundant supply. It interacts with multi-year deficits, depleted inventories, and strategic accumulation by major economies. Rate cuts become ignition rather than stimulus. Inventory thresholds define the next phase. COMEX registered silver near 50 million ounces marks a functional tipping point. Below that level, the exchange struggles to satisfy delivery requirements without rule changes, position limits, or forced cash settlements. The drain of 37.6 million ounces in 47 days illustrates how quickly stress can escalate when confidence erodes. At current draw rates, a structural shortage could surface within months, not years. Industrial behavior becomes decisive. Solar manufacturers, defense contractors, EV producers, and electronics firms cannot defer consumption. When they confront procurement uncertainty, they secure long-term supply at any price. That shift transforms a deficit into a scramble. The last time an industrial metal faced a similar dynamic, palladium in the 2000s, prices rose sixfold before substitution emerged. Silver offers fewer substitution pathways, implying a sharper adjustment. Central banks create another layer of demand. Russia's decision to classify silver as a strategic reserve breaks a 170-year precedent and signals a reorientation of monetary hedging in non-Western economies. China's accumulation, driven by industrial necessity and reserve diversification, reinforces this trend. If additional BRICS members adopt similar strategies, Even modest purchases would strain a market with only 1 billion ounces of annual supply. The gold-silver ratio adds upward pressure. A historical mean near 15 to 1 contrasts sharply with the current level above 70 to 1. Full reversion would imply silver prices above $280 per ounce, given present gold levels. Even partial compression would generate substantial repricing, not because investors demand it, but because the underlying monetary relationship seeks equilibrium when confidence in fiat declines. Geopolitical risk compounds these dynamics. Sanctions, currency seizures, and trade fragmentation push nations toward assets outside the reach of foreign policy tools. Physical metals meet that requirement. Digital assets do not. Sovereign debt does not. When geopolitical incentives align with industrial and monetary incentives, demand becomes both persistent and non-cyclical. The likely outcome is not a gradual rise in price. It is a structural repricing event. Markets transition from a paradigm where silver is a commodity to one where silver is collateral. In that environment, the variable is not what silver costs. The variable is who can secure it. The system then adjusts around scarcity rather than price. This is the landscape forming beyond 2025. A weakening reserve currency, a tightening supply chain, a stressed futures market, national accumulation, industrial inflexibility. Each force reinforces the others, and together, they move the market toward an era where silver is no longer valued for what it was, but for what it becomes. The only reliable store of value when confidence in paper dissolves. In the end, financial systems do not fail because of a single shock. They fail when the gap between promises and resources grows too wide to ignore. Silver now sits precisely in that gap, a scarce asset confronting an overstretched monetary regime. The dollar entered 2025 with weakening credibility and rising structural pressure. Silver entered the same year with rising industrial demand, multi-year deficits, and rapidly draining inventories. When a currency loses trust, while a critical metal loses availability, the market does not wait for policy clarity. It reassigns value to whatever remains scarce, tangible, and outside institutional risk. That is the shift unfolding now. Not a speculative cycle, a revaluation of what constitutes real collateral in a system built on leverage. Industrial buyers need silver to operate. Nations need it to hedge strategic exposure. Investors need it to defend purchasing power. These forces do not compete. They converge. Once a metal becomes the anchor of three different systems, monetary, industrial, and geopolitical, its price ceases to reflect tradition. It reflects necessity. That is why the coming years will not be defined by volatility alone. They will be defined by a structural repricing of an asset the world has undervalued for nearly half a century. Silver does not become the only real money because markets declare it so. It becomes real money because scarcity, utility, and trust force the system back toward tangible value. And as the dollar weakens, as inventories thin, and as nations reposition, the path ahead becomes clear. The financial world is moving toward assets it can measure, store, and defend, not promises it must believe. The repricing has already begun. The adjustment is far from over.